Hi, everyone. Jim Kruzan here, and welcome to March. I love the month of March because we know spring is just around the corner, although March and early part of April can be a little bit nasty. So we'll see what happens. Hey, we're going to talk for the next couple of minutes about what happened in February and give you a quick economic and market update. We do this to just give you a sense for what happened last month, and it helps to create some narrative when you get your monthly statements and kind of look through where things are. You'll have a better sense taking a step back, looking at things at 30,000 feet. I've been saying for a better part of 2 years now, we follow the data and we look at the data very closely. We're on many of the calls when economic data is reported out, typically 8:30 most mornings. And we felt for a long time now, one of two things will happen as we follow this data. It either continues to weaken until you see a drop. Most recessions don't happen like an airplane landing on a runway, nice, slow, graceful, steady. Things look reasonably, or the expectation is things look reasonably good until they don't. And then there's a sizable correction, both in terms of economic data as well as the market. Or the data starts showing improvement, which should graphically look a bit like a Nike swoosh. And we'll see. We haven't quite seen that yet. In either case, we would hope to see a broadening out. That is to say, other segments of the market start to perform beyond just simply Mag 7. Remember from the December report out, we talked about the S&P's return of 24%. But really, when you stripped out the Mag 7, they performed or provided 22 of the 24% based on their current end of the year stock weighting. So we expect to see a bit of a broadening out. While 2 months is not a year, so far we've begun to see a bit of this broadening out, and we'll talk about that in a moment. So let's get right into this and look at some of the economic data. And this is all fairly recent stuff, some as recently as today. Some last reported out about this time a month ago. Some of this will be refreshed within the next week or two. The LAI, the leading economic index, we've shown charts of this for a better part of 2 years, how it continues to roll over. Here we are 2+ years into it, and it continues to decline. The month of January was down again. There's a little bit of an uptick the prior 2 months. But it was once again down. Credit card delinquencies, those over 90 days overdue, think of that as people missing 3 months in a row. That is now 11.35% of credit card balances or cards outstanding, 1 out of every 9 cards. That's up from last quarter, 11.1, up from a year ago, 9.74. It's a big change, and it indicates maybe some concern or slowdown with consumers. Commercial mortgages on office buildings, also really high. Delinquency rate is well over 10%. Just a year ago, it was 6. Just 2 years ago, it was 1.8. And it's off a little bit from 11% in December. But that's a big, big number. And the concern is, does it get worse? There's $2 trillion worth of these types of mortgages that term out over the next 2 years. They're coming off of very low interest rate mortgages. These are 5-year terms of something like 3%. And currently they're rolling over into terms of anywhere from 8 to 11. But that's not the big issue. The big issue is collateral. Back when these were originated 5 years ago at a very low rate because interest rates were low, the offices were fully leased. Everybody went to work. And there's a lot of collateral. A lot of these empty offices today don't have anywhere near the rent coming off or the collateral, and valuations have been compromised as a result. So many of these, as they go to the negotiating table, are finding that they owe more than what the building is currently worth because of how business buildings are priced, cap rate. And they're just giving the keys back to the bank because they don't want to put up hundreds of millions or tens of millions of dollars of collateral to pay the mortgage down. Manufacturing has been weak, continues to show signs of weakness. ISM numbers, global service PMI numbers are all beginning to fall. Service has been really strong the last year or so, and we're beginning to see a little bit of weakness. Think of services more in line with consumer spending. And just yesterday, the ADP employment survey came out, and it was really weak. That refers to ADP, which is the large payroll service provider. They look at number of new jobs or number of new people that have been added to the ADP system, 77,000 in February. That number was expected to be 148,000, which was admittedly down from January's 186. Later this week, we have the Labor Department, the BLS numbers, which are household survey. Those tend to report weaker looking numbers still. Big ADP numbers the last couple of years, much weaker unemployment numbers coming from household. So we'll see what that looks like. Let's shift for a second and talk about valuations. And I introduced this slide back in December. It's called the Buffett indicator. And it's not a financial ratio that you would learn in business school or in a finance class. It's something that Warren Buffett created so that real time he could assess whether we're in a bubble or not. And it's really folksy and pretty simple. It's the total value of the US stock market. Think of that as the total value of all publicly traded companies, small, medium, large, doesn't matter. It excludes other businesses that are private. Think of all the large partnerships, big law firms, medical systems that employ tens of thousands of people that are all private. Universities, private. So there's a lot of other stimuli that affect GDP beyond publicly traded companies, but that's the numerator. And the denominator is GDP, sum total of goods and services produced and consumed within the US, one over the other. Not a true ratio because there's other inputs into GDP beyond just stock price, but it magnifies the disparity in price valuation. So when this ratio is 50%-ish or so, one could conclude that the market is somewhat cheap. It's not fully reflecting its economic value, which is all a stock price is. And when it gets to 100%, it's now getting a bit overvalued. Stock valuations are pretty high considering that's supposed to be their economic value. The economic value of our whole economy is about the same value. And there's all kinds of other inputs that help to stoke the valuation of GDP. When it gets to 200%, it's ridiculously high. And we find ourselves now in December at 211% at the end of the year, I should say. And that's the highest ever recorded. And why that's a problem is when it gets, these valuations get this frothy, there's generally a large reversion to mean. Call it pullback, correction, or reversion. We've seen it a couple times. Now, the chart you're looking at is not the market, but rather this Buffett indicator. And remember, the indicator is stock market price over GDP. If the market corrects back, the numerator drops and the ratio drops. If the market is correcting back and we also have a recession, then the denominator also drops and the ratio would actually go up a bit. Numerator over decreasing denominator is a greater ratio. So as a result, this shows big swings in stock market value. We're now currently significantly above 2 standard deviations off of the historic trend line. And whenever we've had pullbacks, those pullbacks have migrated down and have bottomed out approximately 1 standard deviation beneath trend line. Right now, we're 67% higher than trend line. So the distance between where we are and average is about as far away as we've ever seen. We had a huge peak followed by a big correction back in the late 60s. We didn't have the Mag 7 back then. We had the Nifty 50. Think of all the baby boomers graduating college in 68, creating families. Gerber, General Motors, Pulte Homes. These were all the darlings of the day. Colgate, etc., until they weren't. And then the dot-com bubble in 2000, where the top 10 names in the S&P controlled 20% of the index. And a lot of those were hyped up because they were large retailers touting all the success they'll have on the internet, which was many, many years yet to come, or technology companies providing access to the internet. And those were all darlings until they weren't. The top 10 names represented 20% of the index. And then we got a little crazy coming out of COVID. There's a lot of revenge spending in certain areas, and a handful of meme stocks and such kind of dragged the market higher. And we had a violent pullback there as well, not quite all the way down to historic trends. And here we are today, even above those levels. And today, the top 10 stocks amongst the S&P represent 40% of the S&P market cap. If we could call 2000 a bubble, is this a bubble of 2x that from a valuation point of view as it relates to those darling names? Perhaps. So let's look at what has happened with respect to market and return over the course of the last month or so. So here you'll see January and then February, and you'll also see year to date. Without going into a lot of detail, you'll notice that the big gains that were posted in January, some of those flipped over. S&P is down in February, up in January, equally weight the same, the Dow the same, the NASDAQ the same, and so on and so forth. But the NASDAQ composite, broader speaking, is down less, actually up a bit compared to the NASDAQ 100, which is heavily concentrated around the Mag 7. The equally weighted S&P is performing better than the concentrated S&P. We're beginning to see a broadening out. Look at stocks and bonds. Bonds are actually outperforming equities in the most part. And the international markets are now starting to perform. First time in many years. And about half that performance is coming from the improvement that we're seeing effectively in the US dollar. And there's been a lot of change in these indices since the end of February, bringing it up to date just the last 4 days in March. So we are beginning to see a bit of a broadening out. And a balanced account, a dynamic global balanced account, is actually performing better, significantly better than the broad-based market. And what about our friends, the Mag 7? Well, it's kind of the bigger they are, the harder they fall. They certainly had been responsible for a lot of the upside. And as you can see, at least for the month of February, on a weighted basis, they're quite a bit responsible for the downside. By the way, in 2000, the dot-com names were totally responsible for the S&P's downside. So you're seeing some similarity as well. S&P was down 1.4. The Mag 7 were down on a weighted basis about 1.4. So there you have it. So that's the news for the month of February. We'll be back again next month with not only a report on the month of March, but also the quarter ending. And we might have a few more slides to share. If you have any questions along the way, by all means, let us know. You can reach us by web, give us a call. We're very responsive to your questions. With that in mind, see you next month. Take care.